All right, guys. Hey, I wanted to thank you for dropping in. This is David Berry, and I'm with the guys from TexasInsurancePro.com. As always, I'm David Berry, your local insurance agent, and I'm the guy that writes the content about the people that want to become insurance agents, looking for more people like you who want to do something in the insurance world, or you want to learn more information about the insurance world. With that being said, today's Hangout video is about the 401k. It's for a lot of the consumers out there. We see a big need. And as always, I'm going to first off start by getting my guys out to introduce themselves. Let's start with Carlos.
How you doing, David? Carlos Salazar here, your local independent agent and your support team for David.
Yeah, Carlos is a guy that that contacts the majority of the people out there, and also when they want to become insurance agents. He's also a life and health insurance agent, specializes in life and health insurance. You have property, casualty, life and health as well.
The
Uh,
generalized license,
yeah,
property casualty, auto, home life, the Ocean Bank commercial.
right. So he knows if he just like the rest of us on here, we can pretty much sell anything you want in the state of Texas between the three of us. And last but not least, I got my man Cecil. Cecil, go ahead and introduce yourself once again.
My name's Cecil Dahlberry, and I'm a local agent here in the DFW area, and I specialize in retirement accounts and also in retirement income. How do you make money?
See, it's funny you bring up retirement income and retirement accounts, and we got today we're saying 401ks, what to do with those 401ks, those old 401ks, how you roll them over, how do you affect them. Personally, I am gonna defer. I'm gonna ask you guys a lot of questions because you guys actually handle this kind of stuff, and I know there are a lot of clients out there that want to know more about it. So I'm probably going to throw you a few zingers. I do want to touch on some things that we've been coming across with the people in the DFW area and across the state of Texas that are looking for more information about becoming insurance agents. But I think that's something that people don't realize, that there are insurance agents out there that can actually help you with your rollovers. But the first thing is that there's so many of them out there. Cecil, I mean, you've been doing this for a long time. Now, I just want to kind of start with you because you're kind of the resident expert on this stuff. What do you think with regards to rollovers? The average rollover, the average 401k, how much is sitting around in the average 401k account?
But right now, the average is just shy of $100,000. It's like right at around 92, 93. Kind of depending on what the market's doing at the time. But on average, it's about 92,000. And of
Okay,
course,
go ahead.
if somebody's not making a whole, if they're not making but 50, 60, $70,000 a year, which is a
Mhm.
good living here, $92,000 is going to get you through 1 year of retirement.
So you think there's a it's you say that it sounds like you're saying that there are a lot of 401ks that are out there. Or there's a lot of people that's got this $92,000 sitting on the sideline, and is it how much does the average person actually need in a 401k? Is this the 401k, I guess, 92,000 at retirement, or just 92,000 in general? Is So like a 50-year-old guy, you think the average 56 55-year-old guy has 92,000 sitting in a 401k?
Well, they don't break it down that way. That's just the average that's in a 401k. So the only
Okay.
time they can look at it is when it's in motion. So when you've left a job or something like that. And of course, that's an average. So there's going to be other accounts that are a lot higher than that. There's going to be some that are a lot lower than that. So
Mhm.
with old 401ks, you just have to make the decision on what you want to do with it. And most people don't know what choices they have. They don't know their options.
I mean, but let me ask you this: the stock market is doing really good, or it's on all-time highs, or something, as they say. Uh, what's the harm in leaving it? If it's doing well, say you only put 30,000 in it, and over the last 10 years it went up to 50,000 or 90,000 or whatever the number is. What's the harm in just leaving it there?
Well, if you're not at that employer anymore and you're just leaving it there, a couple of things can happen. Number one, it does change. So when you're looking at that particular account, you've got limited access to it to actually make choices. So if the stock market does start to take a downturn, things like that, most of the time you only have one time a year where you can change it if you're no longer there. Versus when you were there, you'd have 4 different times each quarter to actually change the investment that you were in. So that's kind of the first thing.
Uh-huh.
Kind of the second thing is nobody's really watching it. Carlos will agree with me on this one. I don't know how many times we sit down with somebody and they literally just forgot they had an old 401k because they've been gone from there for a few years, and they just randomly get a statement and actually open it up and take a look at it and then realize, oh, it's not my current one, it's my old one.
Really?
So we actually see that quite a bit.
Goodness. So I mean, how does somebody forget that they have 20, 30, 50, $100,000 in a 401k? That just blows my mind.
Again, you just do, because the consumer's not sent a statement every quarter. They don't have a login where they can log in and take a look at it like they did when they were with their employer, even though it's usually with another company that's actually holding the funds and doing everything for them. So the other thing on top of that too is you're still paying fees for that. And what you don't realize is if you're no longer working there, your employer is not paying their portion of the fees. So your fees typically go up if you're not there anymore. So less of your money is working for you. And on top of that, you're not putting more money into it. So that's what kind of starts, it's kind of like a snowball effect.
Oh, wow. Oh, wow.
So usually you're paying a lot more in fees, which means typically you've got less money.
Oh, wow. So it actually can affect negatively and decrease the amount in the 401k is what you're saying by just leaving it there.
That's right.
Now, so well, I guess the topic of our hangout, what would you do? What would somebody do with the 401k? What are their options then? I mean, if you got the average person has $92,000 in a 401k, some higher, some lower. You sitting down across from somebody, what would what would you tell them in general their options are?
Well, the first option always is you can leave it there, okay, which we just discussed all of that. So the next option is going to be that you can roll it over. And some people are a little uneasy because they've heard the term. Everybody's throwing that around. They probably even heard it at their bank too. When they're just going in there to make a deposit, they usually bring it up there too. But most people don't really understand what it is and what it entails. And it's really simple. If you sit down with somebody that knows what they're doing, they're going to make sure that you're not going to pay any taxes. You're not going to pay any penalties to the government when you do move that money. But the main thing is you want to make sure it's going into something safe that you're comfortable with as far as the investment side. But when you're doing that rollover, it gives you more control. So remember, if you just leave it there, you're getting a statement maybe once a year, okay? With these, sometimes it can be once a year because it is a safer type of investment. But typically when you're looking at that, you have more control. So even though it's once a year, if you wanted to pick up the phone and say once a quarter, hey, I want to take a look and see how my account's doing, or I wanted to change something, number one, you can do that. Okay.
So let me ask you this. So you're saying that the options are to leave it or roll it over. Are there any other options?
Yeah, there's a couple more options, and Carlos can probably go over those as well.
Carlos?
Well, the thing about this is it's you're going into retirement, right? So, you can hear me?
Yeah. No, you're fine.
Okay. You said, whoa.
You're shiny like me.
Okay. So anyway, what is retirement? Think about it. What's their biggest fear going into retirement? Running out of money, right?
I get.
So you got a bucket of money. So you got that bucket of money. So what's going to happen to that bucket of money if you're just relying on that retirement insurance? So you need retirement insurance. So what we can do is you can get a grip on it, or you won't lose any money.
So your option is to leave it, roll it over, take the money and run. Can you take the money and run?
Or roll it over.
So you got three options. You can leave the money in your old 401k
and lose money,
and possibly lose money.
More than likely, just like what happened in 2008.
Like 2008, right? Roll it over.
Or 50%.
Roll it over to a
private pension plan.
Some type of private pension plan or some type of private plan. That's a qualified. That's let's talk about that in a minute.
Talk about that.
Pension plan. Or the other option is they can take the money and run. Why wouldn't someone just take the money and run? Say they have an amazing business idea and they want to design, they want to design powered roller skates. I don't know, something special. Could they just take the money and run?
You can take the money and run. I mean, but you're going to pay the penalties and the taxes, and it goes. Yeah. So you're losing 30% right off the top. So do you really want to lose that much money?
I don't know. What if they think they can make 200%? Maybe if they can make 200%, but if not,
well,
it's a gamble, I guess.
It's a gamble. So, but anyway, when you roll it over, you can put a grip on it. Okay, so you can guarantee your principal's protected. You got a rate of return, and it's income protected, so you'll have income for life. And some of our carriers will give you a 10 to 20% signing bonus.
Keep it neutral.
Keep it neutral.
Keep it neutral. No carrier names, please.
I didn't say no carrier names.
No carrier names. But it sounds like, and correct me if I'm wrong, it sounds like, let me ask you this, okay? Because we've heard these things thrown around. And so it sounds to me, I'm not the expert. It sounds like you guys are talking about stuff like annuities. You're talking about life insurance products of some sort.
Well, Cecil, Cecil can elaborate on this. What is Social Security, Cecil?
Well, that word annuity gets thrown around, and for some reason, people think it's a negative connotation. But Social Security, everybody knows what Social Security is. When somebody gets older, they get a check. They get that check until they pass away, and then it stops coming, right? Because you're no longer alive. Social Security is actually the largest annuity in the world. That's what it's actually paid out of. So, the thing that I've never really understood in my career is why all of a sudden this annuity became a bad word in some circles. It's not a bad word at all. That's the way a lot of our senior Americans get paid these days, because they're getting that check. So we do have instruments that are private ones. Those are the private pensions. And some of the carriers, like Carlos is saying, some of them are given 20 to 50% as a sign-on bonus if you place your funds with them.
Did you say 20 to 50%?
Yes, 20 to 50%.
Yes, sir.
So okay, wait a minute, because we've never really talked about that. But the average annuity, the average 401k has $92,000 in it.
Round it out to 100.
And there are products out there that now, do they pay if they roll it over? Say they roll it over into one of these products, these annuity products or whatever. The concerns I see are, number one, access to liquidity. Number one. Number two, I see problems with, because of the way some annuities are set up, and maybe you can address this. So access to immediate liquidity is number one. Number two, any penalties, of course, and then you're saying that the $100,000 could turn into $150,000 overnight. Is that right?
Yeah.
So what happens if they have an illness, they get sick, they need the money, and they are in one of these products? What are there options either way? Who is this designed for?
It's really designed for someone that's thinking about retirement income. Because remember, money in an account doesn't mean anything. What it means is there's money in an account. What you're really looking for on these products is you're looking for an income later on down the road. Okay. So that's really what makes the world turn around, because once you retire, you're no longer able to go every day to a job where they're going to write you a check. Now your own money's got to be making money to write you a check. And that's what retirement is for most people. So the carriers there's a few strings attached to it. I don't really want to get bogged down in the details, but we do go over all that with all of our clients. They are custom fit for each and every client as well. So, just like anything else, what may work for one person may not be what the next person needs. So it's not a one size fits all. That's why we do always want to sit down free of charge and go over what you currently have.
Let me ask you this. So you're telling me that there's stuff out there that they can roll it over. What are the downsides as far as, say, you roll it over and the stock market crashes the day after you roll it over? What is the pros and the cons of rolling it over into some product like this?
If you're rolling it over into the real safe ones, you are kind of giving away a portion of those returns. But again, we also have some products that will guarantee you a rate of return. It's not going to be 20, 30%. Okay. It's because it's going to be put in safe investments. So we do guarantee the principal in most of those accounts. We're also going to guarantee on a yearly basis the gains. So anything that you gain during that year gets locked in, and you can't lose those either. So you're not going to see those big, huge returns of 20 and 30% because you're not going into those risky investments and kind of risking everything. So
are they actually investing it in the stock market?
Actually, no, they're not. In most of the cases that we use, they're not actually putting it in the stock market. They're just watching the indices. So, you know, the S&P 500, the NASDAQ, the Dow, they're kind of looking at those indexes, but they're not actually buying stocks in those. Okay. So it's actually just following those. And we explain all of this to anybody that we talk to about it, if that becomes an option that we want to look at for them. But that's pretty much it. You know, if you're going to be able to have a paycheck until you pass away, then you're going to have to put that in something that's going to be there for the long haul. So we're not really going to have companies out there that are going to be investing in tech stocks, you know, and startups, things like that.
Right.
Because we want to make sure that they're going to be there, because the average retirement is actually going up. I mean, used to, it was 10 years. Now we see 30 and 40-year retirements where people have been retired for that length of time.
Wow. So that money that they have needs to last 30 years, and it needs to grow for 30 years, going two ways, in and out.
That's correct.
So then really that $92,000 401k average is a very small number with us living longer.
Right.
And that's an issue. That's an issue that we ought to one day talk about, that, because I think that just these products we're talking about, I know that there's some life insurance versions of these products that we ought to address that would be good when you're younger, and especially for people who have young kids, like the index life insurance, index ULs. Wouldn't you agree?
Absolutely.
We ought to talk about that on another video one day. But so 401ks.
So David, you'll have a cash bucket. Okay, so eventually you froze. I don't know what happened to your screen. Are we live?
We're live. We're live. So you
kind of froze there.
Oh, that's okay.
Okay. So you got your cash bucket. That's your 401k money. You have that right there. Eventually you're gonna run out. And then that's where your income bucket continues on your rollovers. So that's why you get the income for life.
So that's something, sounds like a very special product that you guys have, that maybe it's a one-on-one thing, because it sounds like you're adding money, and not necessarily if somebody's already in retirement, that product sounds like it may or may not be for them. I don't know. But
yeah, everybody's different. Every family's different.
Yeah, every family's different. We got to keep that in mind when we talk about this stuff. I mean, so what you're telling me, and let me kind of recap this, because I don't want it to get too long in the tooth. You guys asked me to keep it focused. This is a product that has, I'm going to kind of paraphrase it in my regular everyday David Berry, I've been in insurance forever ways, you know. You're saying that this product, the way you structure rollovers, they can take the money and run in their rollover. They can roll it over to something that's, now they can roll it over to something that's risky, right? They can go from Smith and Barney or whatever to Edward Jones or to Fidelity, right? They could do that.
What's the name? What's the names?
Oh, whoa! No names. No names.
No names.
I don't have anything to do with those people, by the way. I have nothing to do with those people.
Some of them guys.
Beep. Okay.
Some of them guys.
I need some beeps.
Their minimum is 250,000.
We need some, okay. Wait. Now that's a good point. Real quick, is that this $92,000, I remember you telling me this, that this $92,000 average 401k, most companies will not service the person that only has $92,000. So is it a safe assumption to say that, first off, those people are probably having a hard time? If they're having a hard time with their $92,000 401k, what to do with it, they probably should contact you guys, number one.
Absolutely.
Because they got to have, how much does the average, like, we're gonna say the name rhymes with Dead and Bones. How much does the average financial planning organization, let's call them that, financial planner, require you to have in your portfolio in order to get service from them?
250.
250,000. And you guys, so number one, let's go back.
Talk to you.
So otherwise, if you don't have 250,000, they won't talk to you. So they won't really talk to the average person. But there are solutions for folks that will protect the principal that they have, that $92,000 that they have.
Right.
Right. And then if the stock market goes up, you participate in the gains, you get a percentage of the gains, right?
Right.
So is that what they call participation rate?
Yeah, but most of our carriers, most of the ones that we look at, we want to make sure it's better for the client.
Right.
Okay? That's why we have access to over 300 companies.
Right.
And we're going to custom build that to you. But the short answer is, yeah, you're going to get a portion of it.
Right. That's
participation rate. Some of them don't have participation rates, and you're just in there for 100% up to a certain amount.
Up to a certain amount. And I think I saw that once on a product, because I have written a couple of them. And if I remember correctly, his was 100% participation up to something like 18%. And it's been ridiculous how well he's done in the indices. I won't even mention the names, but yeah, I've done a couple of these. But I did the life insurance ones. So because this was somebody who didn't have anything, he wanted to get life insurance. We did a number of policies, and that was a totally different type of product, totally different. It wasn't a rollover, but it was similar. So it protects the principal. It has a participation rate or 100% up to a cap interest rate. Now, your average financial planner might say, at most places where it's 250,000, no, that's not the best thing for you, because you have this cap. You have caps here. But from the sounds of it, what happens if the stock market goes to 0% or below, or drops down and we lose a lot of money?
Just like that pen did. When you dropped your pen and hit the floor, that's what it does. It hits the floor.
It hits the floor. So if the stock market hits the floor, and the stock base when it hits the floor, but if you're
right there, you don't lose the stock market crashed because it went negative. So you're zero.
But you had airbags. You keep them from crashing.
That's right.
That's a safety net.
Okay, So you say, okay, with the exchange of having this, percentage of the gain, or 100% up to X amount, or participation rate, you're guaranteed to not lose your principal.
Correct.
Not bad. Not bad. So that means that if you're interested in something like this, and you're one of these people that have less than $92,000, you might want to talk to a good insurance agent that understands these, or a good finance. Is that what? These are just insurance products, correct? Or are these securities products?
Some of them can be.
But you're not dealing with any securitized stuff anymore.
Right. That's not what we're talking about today.
So,
but wow. I do want to go back to one thing that you said is, those financial advisors at those big box places, we'll just say.
Big box, I like that.
With those places, it's not just that it's $250,000 is the minimum that they'll take on. It's also that they don't do the income. The only thing that they're taught how to do is how to grow your money and grow it through the stock market. They're not taught how to actually plan for the income side of things. There are some that do, but by and large, that particular industry of financial advising that way, that's what they're doing.
They're gambling. They're gambling.
Grow your money, and that's it. You're gambling with your future.
Oh, wow.
And what we do is we teach people, okay, well, hey, why don't we kind of tone down the gambling portion of it, and let's take a look and pressure test what your plan looks like if you've got one, and we'll be able to tell you if you've got a plan in place how much you're going to be able to get every month when you get ready to retire.
Wow, awesome information. So if you're interested, we're going to put some links and a form. If you're interested in more information about this product or anything we talk about in this video, I will have a link to this video and into a landing page that will go to you guys regarding if someone needs help with the rollover 401k and they want to protect it against the volatility of the stock market with what you're talking about. So that's pretty awesome. Real quick, let's touch on some other stuff. The Carlos, you got access to the website this week, and you saw the tons and tons and tons of people that want to become insurance agents of all things.
Right.
First off, what's your impression of what's going on out there? You think there's a need for people for help?
What's that again?
You think there's a need for what we do? It seems like there's a lot of interest out there. Do you notice?
There is a lot of interest. It's just they're kind of surprised when I called. I said I didn't do anything. I didn't submit my information. Well, I got your information. I got your name and number and your email, and your question what you wanted.
So we're seeing a lot of people that want to be property and casualty, and a lot of people that just don't know and they just want help. And I think it's important to kind of keep doing this hangout because at least they get an idea of what insurance agents know. Now, you talked to an interesting lady today who kind of changed gears a little bit and just really touch on this property and casualty thing. And you and I discussed it earlier today. She wanted to sell auto insurance to her 300-400 clients out there, and she's in Dallas, right?
Yeah, she's in Dallas, and she just wanted to concentrate on auto insurance, but not to get into detail with her. Just what they don't realize is that, between our conversation we had earlier, there's a lot of moving parts for auto insurance.
Absolutely.
I mean, there's billing and payment and servicing, and that's why you have all these agencies doing those agency fees.
Right. So especially, I'd have to take off my glasses, but especially for your non-standard.
Well, first of all, you got to get licensed. Then you got to get E&O, errors and omissions, and then you got to get appointed, and then you got to get your rater.
And it's not even in that order. I mean, you think about it; they can't even in property and casualty. It's infinitely more difficult. And from the world I came to, maybe it's easier now, but it's infinitely more difficult to get into that world, know what you're talking about, and get those appointments. Because otherwise, you get stuck selling, doing the burger job, and that's selling car insurance with liability only. And that, I think that's a real big challenge for the majority of the people out there, is that they see these other places that are getting these tax offices that are starting their non-standard auto business, and they'll get the insurance company that only wants to sell liability only. And so as an insurance agent, that's really the lowest common denominator, least common denominator when it comes to auto insurance. And I call that the burger job. I can train anyone to do it, but the numbers are very difficult to work out and to make it to where it's profitable. So we said, what do we say? You got to get licensed. So you got to do all the stuff you do on life and health side. You got to go to a pre-licensing course or self-study some kind of way, then pass the test. Once you pass the test and get your fingerprints, you got to apply. But while you're applying, you've got to get appointed with somebody, because the state of Texas, they won't appoint you unless you have a company, an insurance carrier, or an insurance agent like me or you,
right,
or Carlos.
But it's easier to get. And Cecil will agree, to get your life license, because we can help you with the E&O and the appointments and how to pass the test, instead of having all the moving parts with PNC. Don't get me wrong, if they want to do PNC, that's by all means go ahead and do PNC.
I mean, that's how I cut my teeth. Is that 20 years ago I started out in property and casualty,
but
and I grew into this.
In life insurance.
Well, I mean, here's the thing. It's profitable to the extent of you don't need as much infrastructure with life and health. With property and casualty, the insurance company kind of wants you to try to design your own infrastructure. You don't want to you have to be careful with the contracts you take because the more commission, the more responsibility they give you. And in general, the max commission you can get on a PNC is about 15%. If you're lucky, you can buy into something, an organization that'll get you 19 to 20% of the annual premium. But with that annual premium, that 20%, you've got to service that policy every time they call in. So yeah, you kind of adopt your clients and you become part of the family. But they shop for insurance through you. The challenge is everybody has those carriers.
And they'll drop you for $1.
My cousin just switched to another carrier. So
no names.
I just switched to another carrier because he wanted to save a couple bucks. And I can't really, he wants to save a couple bucks. It is what it is. And that's property and casualty, but he'll never switch his life insurance.
Hey, on another note, I'm talking about, a family. One of my daughters, no name. I helped her up her liability limits to 100, 300, and she got a better rate.
Yeah. So those are little things that, as a property and casualty agent, that you have to be able to, you have to know. But that's something that you don't learn on a non-standard side. That's something that you actually learn when you're in street smarts or you have a good training from an organization. That's why it's important, if you're trying to get in at property and casualty side, to actually get in with the mentor, get in with an agency and work with them, because there's a lot of stuff that you just can't learn just by getting in the book or just signing on, getting appointed with the carrier. And even if you got appointed with the carrier, if you didn't know that information, it's so counterintuitive, you'd never figure that out. So those are some of the challenges with property and casualty. But there's no shortage of people out there that actually want it. And quite frankly, it's not for the faint of heart, because it does take a lot of energy. It does take a lot of resources. Cecil's like, yeah, whatever. Cecil, are you doing any claims? Have you done any claims lately?
No, I haven't. Yeah. It's been kind of a slow storm season. So,
do you do any fire? Would they possibly dispatch you for the fires that are happening around the nation?
Yeah, actually, I'm taking a course this week and next week. 2 different courses. That's actually what it's geared towards is total loss. So it teaches you where you walk up and there's nothing but a foundation.
Total loss.
Yeah, well, the thing is, on that side of it, there's lots of tangents we can go down, but the courses that I'm taking, it'll teach us how, because we have to sketch the house.
That's easy.
The total loss. So you walk up to a foundation and then you got to find blueprints at the county or the city, and then you build the house in 3D.
Well, I have a contractor's license. I do that anyway.
Yeah.
That'd be right up my alley.
Yeah.
Maybe I need to get an adjuster's license and take that course, because I'm good at that already.
Yeah.
But so it's right up your alley. It sounds like you might get dispatched. So let us know if you're not going to be here one week.
Yeah, I will.
So waiting for that perfect storm.
Well, it seems like he's got the perfect fires all over the nation. If you're an adjuster, you need to talk to Cecil. He'll tell you about it. He's certified with a bunch of folks. You're certified to do like steep roofs and all kinds of stuff, aren't you?
Yeah. Yeah, I can do steep roofs. I think up to 6-story is what they'll allow me to get on top of.
Wow.
There's that. There's also auto that I'm going through now. So not just on the property side. I can do auto. That's part of the course that I'm going through the rest of this week.
So, wow.
So yeah, it's a little busy.
Wow, that's awesome, man. That's awesome. Yeah. Well, I wish you the best of luck on that. So thumbs up, thumbs down to property and casualty. If someone wants to sell auto insurance, Cecil, I know what do you say? Thumbs up, thumbs down?
Yeah, honestly, in the beginning, I say thumbs down, because just like y'all are saying, a lot of the carriers. I mean, I've had my PNC license in the past. I got rid of it because I just didn't use it. Mm-hmm. And the reason why I didn't use it is because it wasn't cheap if you wanted to be independent.
No, it's not. It's not cheap. It's just because I mean, I think about I have Arizona Mission. I carry an office. I have let's see, I have all my systems and stuff in my office, of course. I have let's see, what else? You know, my comparative rater, which that's 100 and some odd dollars a month. My E&O is about $100 a month. My agency management system is about $100 a month. My office, with all of that, I think I probably spend just on for one person just on basic expenses. I would say 1,500 $1,500 a month. I actually could look in my QuickBooks and it tell me exactly what I spend every month. But before I make a dollar, I have to make sure that I have that much money coming in, and that's because some of the carriers that I was appointed with, they quite frankly don't want you to work from your home, and that's a big huge disadvantage for people that want to get in the insurance world, is that they want you to have an office, and then yeah, it's very expensive. Another thing is they don't take just everybody. You know, your better carriers are saying no, go through an MGA, go through an intermediary, but we don't want you to have access to this carrier because we think we're special, even though 10 people on the same street have that carrier, one way or the other. So it is a tough business. And then if you want to get in the preferred side, if you want to get on the side of more than just non-standard, there's a lot of moving parts in the policy. A lot of things that you can add, a lot of things that you can remove. But if you don't know what you're selling, then you could end up filing claims on that Arizona Mission. So there's lots of reasons why you want in the insurance world. You want to get a mentor, regardless if it's property and casualty. So I agree with you there. I mean, it took a lot of mentoring and a lot of training for me. What about you? What say you, Carlos?
Thumbs down. I've been there, done that. So, it's the calls, the servicing. It's just a lot of moving parts that, it, you can be successful at it. I mean, that's your cup of tea, go for it.
Yeah.
Yeah. I'm not going to.
Now I'll say this. There's a lot of there's a heavy movement towards automation in the property and casualty world, and I'm starting to see carriers that are using voice attendants to where we can call in as an agent and get service without talking to a rep. There's going to come a day where the lower end of property and casualty gets automated completely to where you don't really need the insurance agent. While that's good for the insurance company, that's good for the consumer, it's also bad for the consumer because they replace themselves, they replace the agent and become the de facto agent, if you will. So that's a challenge with what's going on in the property and casualty world, because so many people now represent these carriers that they're the only differentiator. I can no longer say that the guy across the hallway from me I have an advantage over him because he and I have the same companies, with the exception he's also appointed with a captive company, because that captive company knew that they weren't as competitive anymore, so they decided to open it up. There are a couple of them that are doing that. So with that being said, we've joined forces. There's no sense in us competing with each other, and that's a shame. That's a challenge with this business, is that it is very competitive, very difficult. On the other hand, what you guys are doing is still uber specialized, and there's a huge need for it. And I give property and casualty for the new agent today, I give it a thumbs down too, and it's because of all the stuff we mentioned. I also have to say that with property and casualty on the lower end, unless you're specializing in something, like you get into business insurance and you specialize in a type of business that you're familiar with from another career, it makes it very difficult unless you get a lot of expensive training to get started, or you have a lot of good mentoring, or you get plugged into an agency and plugged into an agency system. So there's a lot of opportunity for growth at one side, but on the other side, there's also it's in this big, it's in flux right now, in my opinion. All the old agents are getting old. The industry is aging, and the new agents are saying, "What the heck you guys doing? You mean to tell me we got to do insurance a different way?" So automation is going to play a role. All kinds of stuff is going to have to play a role, and it's just evolving so much. And then you look at how much you get paid: $1,000, $2,000 a year for an auto insurance policy, and you get a 15% commission, and you got to split that. So the max the new agent would probably get is about 10%. That's $200 a policy. That's not bad, but you got to take the phone calls. You got to make the changes. So there's a lot of stuff that says that you've got to be really sharp and really solid if you're going to start a property and casualty business, because it's not monthly premium. Like Carlos, like you were saying, on the lower end, they got to charge fees. And if you're charging fees, you're not able to compete with the guy that's not charging fees. So, but as we discover, life and health, I'm loving life and health. And that's where it seems like that's where the new recruits are going to go, because it has the least resistance. So for what it's worth, 401ks have life and health solutions. Senior insurance has life and health solutions. Your income planning that you're talking about, Cecil, has solutions, have life and health solutions. There are a lot of life and health solutions that the right people, if you get into the insurance industry, you should really consider that, because you can still work part-time on your day job and then at nighttime, the evenings and afternoons, still work on life and health and get training and mentoring and coaching, is the way it's looking. And you get enough of the same types of things that, you can actually build a very good career. So I encourage anybody that's looking at the video that actually is interested in becoming an insurance agent to consider life and health, as well as aside from property and casualty, and possibly doing life and health first before they do property and casualty, because I think that's the easy way out.
Yeah.
That's my opinion and my soliloquy for the day.
Agreed.
So, guys, what do you think? Should we call this hangout success and put this one in the bag?
Yeah.
All right. Any last words, Cecil?
I would just say I completely agree. I think life and health is the way to go. It's a lot less startup cost too.
A lot less startup costs. Carlos, what you have any final words?
Well, I agree with you guys, and I mean, my thoughts, and it's a lot easier than the P&C world, the life insurance world. It's a lot easier.
And for me, regardless of whether you were looking at this video and trying to get tips on 401k rollovers, what to do with your $92,000 on average for 401k, or whether you are and you're trying to you have some money at an old job, or whether you're a new person that's gone to our website and asked for information about becoming an insurance agent, we want to thank you for stopping in. And if you have any questions, feel free to comment. If you thought this video was good for you and it gave you some information, please give us a like. And we love your comments, and subscribe. And until the next time, we'll see you guys soon. Peace out.
And we'll be in contact.
Yeah, we'll talk to you later.
Bye now.